Hello, can you hear me? Great, great, great. So, welcome everyone. Good morning, Deloitte colleagues and invited guests, and welcome to, I think this is the third in a series of thought leadership exercises between Deloitte and UKGCC. Today's topic is enhancing the investment climate in Ghana, the role of transaction advisors for business expansion and growth. To kick things off, I will invite our Africa Infrastructure and Capital Projects partner and the leader of the Strategy, Risk and Transactions team in Ghana, Mr. Yao Apialati, to give us the welcome address. Thank you.
Thank you very much, Kuku, Honorable MC for the morning. So, good morning, distinguished guests, business leaders, investors, Deloitte colleagues, ladies and gentlemen, and our honorable participants online. I'm pleased to welcome you to today's session of the Investment Readiness 101, a practical guide for business webinar series, proudly hosted by Deloitte and the UK-Ghana Chamber of Commerce. Ghana is one of West Africa's most dynamic and business-friendly economies. With a growing middle class, a vibrant entrepreneurial ecosystem, and rich natural resources, the country offers compelling opportunities for local and foreign investors. I have some statistics for you. In 2024 alone, Ghana attracted over 620 million foreign direct investments. Notably, about 140 projects were registered, with services and manufacturing sectors leading the way. And in terms of structures, Ghana is broken down into, our economy has got three sectorial structures: manufacturing, services, and agriculture. Over the last few years, we've seen services driving the way, and in the last year, we have about 140 projects registered with the Registrar General of Companies. And in the first half of 2025, as at the end of June, foreign direct investment increased by 382% over first half of last year, signaling investor confidence. Yet, despite this promising environment, many businesses, especially small and medium-sized enterprise, what we call SMEs, which account for over 70% of Ghana's GDP, face significant challenges in accessing capital for expansion and growth. These challenges arise from limited financial literacy, that's number one. The second issue is regulatory hurdles. Third is underutilization of technology, among others. Unlocking Ghana's full investment potential requires more than just a conducive environment. It demands expert guidance to navigate complex transaction processes and develop robust, investor-friendly business strategies. Transaction advisory services covering finance, legal, governance, and regulatory environments are required to support business navigate through these challenges. From strategy refinement, financial modeling to deal execution and post-merger integration, transaction advisors support business to navigate these complex challenges. This is the third of business dialogue that Deloitte hosts with the UK-Ghana Chamber of Commerce. So I'll give you some history. So the first one was held in April 2025, what we call the first quarter series. It was on the topic demystifying investor expectations, what you need to know before seeking capital. And we had some very good participation online and in the room. The second, we had also a hybrid session, virtual and in-person, was on the topic enhancing investment climate in Ghana, the role of government, where we invited regulators, government representatives in the room. Today, we are proud to have the third session, Enhancing Investment Climate in Ghana, the role of transaction advisors for business expansion and growth. This event is part of our Investor Readiness 101 series, which brings together business leaders, investors, advisors to explore how professional transaction advisory services can accelerate growth in Ghana. We have heard some myths and maybe some facts, but some of the myths I want to share with you is that we hear businesses talk about the fact that transaction advisors are expensive. And sometimes they think that an advisor looks at your watch and tells you the time. Please, that is not the case. We've had instances where business have been overvalued. The first seminar we had, one of our speakers gave a very good example that he met a young man who walked up to him and he said he has a $4 billion business. A few years down the line, he met the man working at a commercial bus station, working on the roadside. He said, it's not a guy who has a $4 billion business. What happened to your business? He has just overvalued his business. And that $4 billion is just in his head. This is why you need transaction advisors. Let us not be thinking about cost and forget about value. A former president of Ghana once said, we should be people who know, or we should not be people who know the cost of everything and the value of nothing. Transaction advisors such as Deloitte are not expensive. We give you value for your money. We look forward to an engaging discussion on how to build investor-focused business plans, structure transactions, and harness innovative means to enhance investment outcomes. Thank you for your participation, and let's fully participate, and we look forward to a fruitful discussion. Thank you once again.
Thank you very much, Yao. A very informative presentation. And next up, we have one of our visiting Africa partners, Mohsin Khan, to give us the opening remarks.
So, good morning, distinguished guests, colleagues at Deloitte, and ladies and gentlemen. My name is Mohsin Khan. I lead our Africa strategy and transactions business, and I'm very excited to lead a team of business leaders from Deloitte Africa, comprising the following who will be on the panel today. So we have our Africa corporate finance leader, Jonathan Godden, our Africa PMI, so post-merger integration and value creation services leader, Angela Rogan, our valuation and modeling leader, Jared Mudley, and our transaction services leader, Sean McPhee. Obviously, Yao is our host and leads our Africa infrastructure and capital projects and real estate practice. And Samira Karantara is a manager in our corporate finance team and will be moderating the panel this morning. So as we begin, I invite you, focus on the indispensable role of transaction advisors in shaping the future business growth and investment. So as Yao mentioned, transaction advisors play a key role in assisting businesses, a critical role, I would say, in helping you to design compelling and effective business plan and business cases, identify and communicate their core value drivers, and structure deals that importantly maximize value while mitigating risk. We harness the data and technology to enhance transparency and inform critical decision making. So this business dialogue is dedicated to highlighting how transaction advisors serve as catalysts for business success. So we'll delve into how our expertise helps business develop strong strategies and gain practical insights essential for growth. As attendees, I believe you will walk away with actionable guidance, gaining a deeper understanding of deal structuring, and valuable connections that support sustainable business development. So we look forward to your active participation, and we're happy to engage you after the event. And for those of you online, really keen to hear your questions as well for the team. Back to our MC. Thank you.
Thank you.
Thank you. Great. Another round of applause for Mohsin. Thank you very much. We have next up a presentation from Dennis Brown. Dennis, yes. Dennis is an associate director with the SRT team in Ghana, and he has a presentation for us. Come on, Dennis. Yep.
All right, good morning. Just to be sure I don't cover the screen, I'm going to have to move this a bit to the side. I hope it's fine. Okay, good morning once again. Let me use this opportunity to welcome our Africa leaders. Let me use this opportunity to welcome our Africa leaders. Understand you came in yesterday night. It's been a short while, but I hope you have enjoyed Ghana so far. And I want to promise you we are going to make you enjoy a bit more. We want to beat the Nigerians, for that matter. So hopefully we are able to do that. So as indicated by Kweku, my presentation is on the role of transaction advisors. I know that is what we are going to discuss with the panel later on. Hopefully I'm able to set the tone for our discussions later, where we get to dive deeper into the role of transaction advisors. Let's go back to the preceding slide. Yeah, okay, good. So just a quick one on the outline, where we'll talk about enhancing investments in Ghana, what it will take to enhance investments in Ghana. We will also look at the investment transaction process. Is going to be an overview. That is to sort of lay the foundation for us to better appreciate the role of transaction advisors, and then we will conclude. Hopefully my presentation is as short as I initially imagined it. Next slide, please. All right, enhancing investments in Ghana. So we've covered a number of points here. I think the majority of them we can argue are things that we expect government to drive or lead, but there are also a number of strategies that we think would qualify as advice to private sector players in the investment ecosystem. The first on the list has to do with upgrading of our infrastructure. I think for the locals, we all do appreciate that infrastructure is a big thing for us. There's a huge gap, and that in some instances has deterred investors, and this is something that we've been talking about for years now. It's been government traditionally that has been leading infrastructure development, but these days, or more recently, we've seen models like private public partnership being deployed to deal with our infrastructure challenges. And so upgrading infrastructure is one of the key things we would look at for enhancing investments in Ghana. Also, based on our interaction with clients, regulatory complexities has on a few occasions deterred investors. We've spoken to investors where they've told us they started a process, they went a bit deep, and then realized they just can't deal with the current regulatory complexities, although they had sought advice, etc. And so it's one of the areas that we are looking at, that is something that government must lead to simplify, stabilize, and streamline regulations. You don't want an environment, investors don't want an environment where it's so uncertain, you don't know what's coming up in the regulatory space next time around. Also, it's important that we build local investment capacity for an economy like ours, and there are certain laws around local content that has been championed over the years, but we feel a lot more needs to be done. Especially, there's been instances where you have foreign investors bringing investments, and they are basically, working with locals that do not feel any sense of ownership. And so that creates a challenge, it's more like it's not my thing, I'm just working to be paid. And so the extent to which they take care of those investments wouldn't be the same if they are partaking, in the ownership of these investments. And that's one area we want to, advise, if you like, government and other key stakeholders on that. It's important we build local investment capacity so they can, take part in the investments. Also, to provide incentives, that's also something that we have. It can be fine-tuned a bit more. We've seen instances where investors have been giving tax breaks in certain industries, and that has encouraged more investments into that space. There are still a few industries that we think that, things like tax incentives will still drive value, and so that's an area that government can look at. And also, by way of policy, government can, look at developing a skilled workforce. In this case, not just the traditional investment in education, etc., but it should be more targeted, looking at industries that are evolving. If you look at the oil and gas in Ghana, it's still young, but it's growing. If you look at mining, it's also a key area. These are things that we expect government to look at to tailor the educational policy, invest in targeted education to develop the right skills, because these are the industries that are attracting investors, and investors would want to come in and be assured that there is adequate skilled workforce to work with. So that's one thing we also expect to drive investments. Promote investment opportunities. This is something that is also within the remit of government. We've seen government go to international capital market the opportunities in Ghana. This is something that we believe they can do more. Fostering public-private partnership. I talked about it when I mentioned upgrading infrastructure. For an economy like ours, where tax revenue is that low, it's a significant bearing on the tax revenue. Government is having to shoulder all these capital-intensive projects. But we believe that if they partner with private partners and in the right model, a model that assures that they will recoup their investment with the right returns, this is an area that can help deal with some of the infrastructure issues that we have. Then another key thing we want to highlight is sensitizing the SMEs to be more receptive to external investment. This is a big issue in Ghana, where owners of SME type businesses, believe it or not, prefer maybe debt capital, even at stages where it's clear that the debt capital might sink them, just because of the desire to own it all, right? To want to be the one to catapult the business to a certain pedestal, and maybe to be their chest for it. And this is an area that Deloitte is, churning out a lot of value, working with institutions like the Ghana Venture Capital and Private Equity Association, GEFCA, to sensitize SMEs on why it is more beneficial for them to access, let's say, equity capital as against debt capital at a certain stage of their maturity life cycle. And so we believe it's early days yet. We believe in the medium to long term, this is something that is going to, boost investments. Once SMEs, because when Yao, did his presentation, he talked about SMEs contributing to the tune of about 70% to the economy. And so these are the opportunities that are available in terms of investments. And so if we can get SMEs to be a bit more open and receptive to investment, external investment, that can boost investment. One other thing we've noted, particularly with the same SME type group, is the lack of investment in information management systems. So you have SME type businesses who have owners that can tell you all about the business from the beginning to where it is now, can tell you all about the industry. They seem to have a good knowledge, but very little of it, is captured in proper record keeping and, information management systems, etc. And we've seen instances where it has been a deal breaker, where you are telling the stories, all right, they sound convincing, but I want something more to support it, from the perspective of the investors. And this is an area that we are also pushing with GEFCA to get SMEs to see it as a priority area, investing in proper information management systems that to boost investments. Then investing in research and development, we think it's very important. Very few companies have departments or teams that are, driving research and development, which is not the desirable position to be in. We believe that research and development is one area that can unearth investment opportunities, can lead to development of new products, which would create new investment opportunities. And so it's one area that we think that private sector players in particular can look at. Also, for private sector players to prioritize sustainable practices, we've seen that sustainability has become a big thing, especially over the last 5 to 10 years. A lot of the investors are not just looking at monetary profits or returns. They are also asking questions around environmental impact, social impact, governance structures, etc., which is what perhaps we all know as ESG. And so this is an area that businesses would want to focus a bit more on, make sure they invest to get it right. And the last, which you typically won't see in a presentation like this, so maybe let's say it's out of my bias, I think that we need to sensitize players in the investment ecosystem to prioritize transaction advisory support. I mean, an investment transaction is not like picking a cook from a shop. It's far more complex, and it's capital intensive for most parts. And so it's important that you seek expert advice from those that have done it and have the experience to help you. It's important. So that then leads us into the investment transaction process. This, I believe, would help us appreciate better the role of transaction advisors. So this is just an overview. I mean, typically for an investment transaction, which is to say someone has money, it could be an institution, an individual, and intends to invest in a business or project. On the side of the ones that have the money, we typically in our terminology call the buyer, and the entities or the investee entities we typically call the seller. It pretty much follows the same process where from the onset, once you have identified the opportunity, you have to strategize to see, how best to go about it. Then you prepare the transaction, and then you conduct your due diligences, which is open up the asset, try to understand adequately the risks and opportunities in the asset that you are buying or you are investing in. And once you are okay, you are good to go. There's a certain agreement in principle between you and the seller to do an agreement or to do a deal. Then you proceed to complete the transaction, which could revolve around things like drafting of legal documents, negotiation support with meeting conditions precedent, etc. The experts in the room will tell us all about it when we get into the discussions, hopefully. And it doesn't end there. For an investment life cycle, the reason why we are typically investing is to achieve a certain objective or to generate a certain outcome. I mean, even if the outcome is not, monetary in nature. And so there's the whole phase where after you've shook hands, there's a whole phase where we need to work to ensure that the value that was envisaged is generated. And that's what we call the post-deal phase. That is also an area that transaction advisors can help with. So let's look more closely now at the role of transaction advisors. What I've done is to craft them in stages, and that's why we went through the overview of the transaction process. Hopefully, it emulates it that well to help us better appreciate the role of transaction advisors. So on the first on the list has to do with strategy and structure. So you would have identified an investment opportunity. You need to carve out the best strategy, or what I would call the most value optimizing strategy, to deliver the transaction. And there are a number of things that transaction advisors, can help with in that regard. First of all, assessing and confirming a business need. Really, does the business need capital at that point in time? What type of capital does it need? What are the various sources that are available, maybe in a given market? And which of them really is suitable for the business? That initial assessment, transaction advisors are able to help with. We also talked about strategizing, so determining the most value optimizing approach or method to deliver the transaction. I've even mentioned identifying potential capital sources, etc. Transaction advisors also help you idealize the transaction process and set timelines, especially for first timers, for businesses or investors that are doing it for the first time. They'll help you, idealize the process. You'd have a good sense of what the timeline would be like, and that then gets fed into your internal plans on how you run the whole show. Then under the transaction preparation stage, where you typically have the sell side or the investee companies preparing for the transaction, that's transaction advisors can help with things like business plan, information memorandum. That is key for going into the transaction, because you'd want something more concrete to show to the buyer, for the buyer to feel well informed, at least acting from an informed position about the business. Your business plan, information memorandum will typically contain all the relevant information. That's something that transaction advisors can help you with. Transaction advisors can help you, cramp up the business in numbers, as they say. So that's where you have your financial modeling and forecast. The ideas might sound good, but how does it show in terms of the numbers. If we invest X amount, how much are we going to generate over 5 years? What are going to be the returns, the cash flows, depending on, what the investors are looking for as well. These are things that transaction advisors can help with. They can also help with vendor due diligences, which is the seller conducting, a review of itself. And typically, the benefit or the approach, let me talk about the approach. The approach is to conduct the review from the perspective of a buyer, because you are going into a transaction. So what are some of the things that a buyer will pick up if they should look at my business, if they should open my business? What are the risks and opportunities that they are going to see? If there are significant risks that needs to be dealt with, if you engage your transaction advisor early enough, you might have time to deal with some of those risks or address them. If not, at least you are well informed. You are in a position where you are not taken by surprise. You meet a buyer who has done a review of your business and is talking about things that you are completely lost about. It tells the buyer that you are not ready for the transaction, or perhaps it's high risk and they shouldn't get involved. Then, of course, business valuation, which can also be termed pricing. Just as in any investment transaction, whatever you seek to buy must be priced. And like I said, pricing the business is not like buying a homogeneous product from the shop, like mango or something, but it will require a lot of technical skills, and these are things that transaction advisors help with. Then you have transaction advisory services, this time on the buy side. So, transaction advisors play across all the stages. On the buy side, your financial and tax due diligences, these are quite core. This is whereby, from my experience, the majority of the due diligence requests sits with financial and tax due diligence, at least in this market. But sometimes we do get requests for commercial due diligence, where transaction advisors are able to help you to look at the market and bottom line, to be able to size up the opportunity, that they are looking at. Operational due diligence is more internal. What are your operational structures? It could revolve around things like your HR, IT systems, internal controls, and governance, and other things relating to your internal structures. Does that point to there being, deficiencies or significant risks that might, have concerns relating to the value of the business or any other risk? These are things that transaction advisors help you with. We talked about business valuation already, so a buyer can also get a transaction advisor to help him price a deal. And then forecast review. On the sell side, we saw that typically is the investee companies that prepare their forecast. The buyer would then come in and review, try to ascertain the reasonableness of the assumptions, whether this is really, speaking to the size of the opportunity, so they can make informed decisions. Once you go through your due diligence process, and you are convinced, both yourself and the buyer, that this is a deal that you want to go ahead with, then you initiate processes to complete the transaction, which typically means to shake hands on it. And there are a number of things that transaction advisors can help you with. There's what we call completion accounts. I'm not going to explain it, it's too technical. I'm not going to explain it, especially in front of the experts that we have here. I'll leave them with the challenge. And then review of transaction documents. Here, I think the transaction documents relates to all the legal documents, sales and purchase agreement, shareholders agreement, etc., that would finally firm up whatever that you have agreed on. And negotiation support. There's a lot of negotiation support that goes into agreeing on the price. Your valuation will show a certain price scientifically or whatever they call it, but it will still be subject to negotiation at the end of the day. And this is something that transaction advisors are able to help with. I did indicate that it doesn't end with the investment life cycle, doesn't end with shaking hands, with the other party. There's a whole support that transaction advisors can provide in the post-deal phase, which is once you put in the money, that money would have to be turned over. It would have to be deployed to do what exactly was envisaged in the right way, using the right strategies, etc., to ensure it delivers the envisaged value, right? And that's what we call the post-deal integration, phase. I must say that it's not every deal that lends itself to post-deal integration issues. Typically, when it's a merger and an acquisition, that's where you'd find a lot of integration issues. But it's also possible that where you have PE investments in assets, where they need to partake in management, they need to have board representation, there might be the need to align objectives, systems, policies, etc. And these are things that transaction advisors can help with. So there are a few things here. Maybe I will just touch on some of them. Post-merger integration services, talked about integration planning, organizational design, cultural alignment, where there are cultural differences that has to be ironed out, system integration, process harmonization, employee integration, etc. Capacity building. With the new entity, certainly may want to chart a new course. It will require some training. Transaction advisors are able to offer support, to build capacity, to ensure that the chances of success are improved. And then other operational support services, including update of various operational policies, manual, development or upgrade or acquisition of relevant software or ERP to staffing support, etc., depending on what the context is, of course. So whilst we say that not every single thing here will apply, these are things that should the situation call for a transaction advisors are able to help with. Yeah, so I think we can conclude now. Let's go to the last slide. Yeah, so in conclusion, what are we saying? That transaction advisory support play a critical role in propelling investments and enhancing value generated from transactions. If you engage good transaction advisors, chances are they'll help you minimize the risk associated with your investments and help you maximize value. And by that, you're basically greatly improving the chances of success. This is an objective to your investment. The chances that you are going to achieve those objectives or goals can greatly be, improved with the involvement of transaction advisors. Yeah, so that's about it. I hope there are no questions for me. The questions should be reserved to the experts in the house. Don't want to go ahead of you, but yeah. Kweku? Okay, thank you.
Big round of applause for Dennis. Thank you very, very, very much for a very, very insightful and quite educational presentation. I think Dennis mentioned this, and he said some of the three things I took from his initial slide was the need to invest in R&D, the need to invest in information systems, and the need to get transaction advisors on board. Yao also hinted to something similar when he said that transaction advisors are not expensive, they create value. This all brings to mind a popular adage, one which I'm sure we all know, that if you think education is expensive, try ignorance. This is to say that some of these decisions, like Dennis said, it's not picking up a cook from the mall. It's a complex decision that requires specialized knowledge. And you don't want to go into some of these things blind. You want a knowledgeable and well-informed partner on your side. Yes, so thank you once again, Dennis. I think next we have Samira, who is a manager in our corporate finance team. Samira Karintara is a manager in our corporate finance team, and she will be taking us through the panel discussion. Yes, so round of applause for Samira. Thank you.
Okay. Good morning once again, everybody. I hope we have enjoyed the session so far. We are going to go into our panel discussion now. We have different advisory leaders from Deloitte who are going to take us through why it is important for us to have a transaction advisor. And we're hoping that by the end of the session, you will see the need for a transaction advisor going into any M&A transaction. So I would like to invite our panel members up first. I'll start with Jonathan. Jonathan is the Deloitte Africa Corporate Finance Leader. He specializes in mergers and acquisitions, as well as independent debt and capital service advisory for both local and international clients operating in sub-Saharan Africa. His expertise include leading sell-side, buy-side transaction advisory and capital raising. He has over 18 years experience in corporate finance and has successfully managed numerous complex local and cross-border M&A capital transactions across sectors in South Africa and throughout Africa. So Jonathan, please join us. Okay, so next I would like to invite Angela. Angela leads the Deloitte Africa M&A Acquisition Value Creation team. She has over 15 years experience working with management teams to deliver value through the execution of integrations and carve-outs. Angela has worked on over 50 transactions across industries with a focus on energy and resources. Angela built her career in London and has worked in Europe, America, and Africa on various transactions. Okay, Sean. Sean is the Africa M&A Transaction Service Leader based in Johannesburg, South Africa. He has extensive experience in acquisition and vendor due diligence engagements, with international experience from his work in the USA and the UK. Sean has played a key role in numerous cross-border transactions, completing deals across Africa, including Nigeria, Ghana, Botswana, Namibia, Kenya, Zimbabwe, Malawi, Zambia, and Uganda. Sean is a qualified chartered accountant and a member of the South African Institute of Chartered Accountants. He also has a Bachelor of Science degree in agricultural economics. Sean. Jared. Jared is a qualified chartered accountant in South Africa and serves as the managing partner for valuations and modeling. He leads a team of highly qualified valuations and modeling professionals located in Ghana, Kenya, Nigeria, and South Africa. Jared has extensive experience performing valuations for clients across various industries, catering to financial reporting, commercial and regulatory needs. He also advises clients on valuation matters related to both buy-side and sell-side mergers and acquisitions. Additionally, Jared spearheads the Africa Digital Initiatives and Innovation M&A service offered across the continent. Under his leadership, a team of over 50 professionals deliver high-quality, insightful, and commercially viable valuation and modeling services to some of the largest clients in Africa. Okay, so we have one more panel member who's Wendy. She'll join us shortly, but I will read out her profile. Wendy is the Africa leader for innovations and ventures at Deloitte, driven by her passion to make a significant impact in the innovation sector. Wendy focuses on cross-industry collaboration, assisting corporations in identifying growth opportunities through new product development, impact innovation, and creating new business models. Wendy focuses on cross-industry collaboration and is the Africa leader for innovation and ventures at Deloitte. Okay, so thank you all for joining us today. And we've had quite a discussion with Yao and Dennis and their presentations. But I'd like to ask, and I'll start with each and every one of you in 2 minutes, if you can tell us what exactly your role is as a transaction advisor. So we've mentioned transaction advisors. So for you on a day-to-day, what do you do as a transaction advisor? And I will start with Jonathan.
Thank you. So just to simplify it, we are a corporate finance team spread across Africa, and our main role as corporate finances is the lead advisory role. And really what I mean by that is we take a side in a process. So we're either advising the seller or we're advising the buyer. And we walk the journey right from strategic concept all the way through to deal closure with our clients. Hi, Wendy.
So, welcome, Wendy.
Yeah, so I was just asked the question, Wendy, is, what do we really do? So, we take a lead. We take an advisory role whereby we project manage the transaction from beginning to end, and we work across the various disciplines of a transaction, from valuations, managing the diligence process, working with the lawyers to consummate the deal. But most importantly, our role is to connect a willing buyer with a willing seller. So thank you.
Okay, connect a willing buyer with a willing seller.
Correct.
Okay, yes. Angela, what do you do?
So my role on transactions is very much to get into how do you make it work and how do you make the transaction happen. Is this working?
No, it doesn't.
And so on the sales side, we start very early on, sometimes even before Jonathan's team are engaged, to say, okay, we're going to carve out a business unit. We know that we want to sort of sell it. We know that there's some value in it. But how do we actually carve out that business unit? And how do we separate all the pieces that go with it? And a good example we did recently was the carve out of Cremora from Nestle. And people here might know that the shared service center for Africa for Nestle is in Ghana. So then we had to work out how do you cut those ties with the HR function, the finance function, and create a perimeter that can be sold. And then you get your banking advisors in, and then we work with management sort of on how do you plan that out and really execute it and get to day one so that when you hand over the keys to the buyer, it's a business that's running and ready to go. And then when you take the buy side, we work closely with our clients up front. So during DD to sort of look at the synergies, what are the opportunities? Is this deal actually going to work? Culturally, does it make sense? Culture's a big factor. And then develop what we call the blueprint, which then sets the framework for how the deal will go and how the integration will work. A lot of time we talk about announcement readiness. So when you sign a deal, you need to know what's going to happen with your systems, what's going to happen with your people. Sort of, I don't know who's read Synergy Solution, but if you don't know what's going to happen in those areas when you sign, you're going to be struggling further down the line to achieve value through the process. So we then work with management. Once we've created the blueprint of how you're going to bring the businesses together, then the plans, so that when you actually get those keys on day one, your business is ready to run, and you get it, and you can report, and you can do everything and start realizing value quickly.
Thank you. Wendy. Wendy, what do you do on a day-to-day as a transaction advisor?
I think we're going up higher and higher up the value chain, because before all of this starts, we normally get called in.
Okay.
And our area is all about strategy on the one side, so strategy and business design. I also look after sustainability and economic advisory. And what's really exciting about that is before we even get the keys to the company, we get to go in and work with companies to understand, or how do they take cost out of their businesses, how do they take advantage of different partnerships, what do they do in the digital space, what do they do in the ecosystem space. And so what's exciting about our space is really working hand in hand with the CEO or excos of our different organizations to help them shape the next 5 years or 10 years of what they're going to do as a business. We predominantly focus across each of the different industries, and a lot of our teams have deep industry skills. To be able to advise at that level, we really need to pull on deep industry skills. So we work not only as a team at Deloitte, but we also pull on subject matter experts that might even be external to Deloitte that we bring on to help us with particular problems or particular strategies.
Okay. Sean, what do you do?
Yeah, I'd probably say from the transaction services team, we're really in the heart of the deal. So, you know, once someone has given you the picture and said the business is worth $4 billion, we have to come and actually verify that and make sure that we understand not only the risks but also the opportunities. So really what we do is we make sure that clients understand exactly what they're buying. So I suppose an easy analogy is when you're buying a motor vehicle, I don't know if you have an auto trader in Ghana or a local equivalent, you're not going to just phone and say, I'm going to take the car. You really want to open the hood. You want to see that no one's fiddled with the odometer. You want to make sure that the tires, you know, have decent tread on them. So that's really what a diligence is about. It's one, confirming the business case and the valuation case. Also making sure that you understand the risk, that your client can take that knowledge into the negotiation once there's price discovery. And a very important part of our work as well is that sale and purchase agreement. I think we'll hear a little bit later deals that go wrong is because of poorly drafted sell and purchase agreements. And when you talk about cost versus value, that is really where you can lose a lot of value if you haven't interpreted the diligence findings correctly in the legal agreement and the sell and purchase agreement.
Okay. And lastly, Jared, what do you do?
Sure. So if I was to summarize it, I would say we really quantify complexity. So if you think about a business, it's a very complex thing. There's the economy, there's the industry, there's the company itself. And what our role is to take all of that information, synthesize it, build a financial model, and come up with a value of the company, which is effectively at the heart of what we do. So if I take Sean's analogy as an example, if you're looking to buy a car, you look online, you don't just buy it immediately, they'll kick the tires. What we will do is, let's say your friend comes to you and says, I want to sell you this Toyota, pay me 500 million for it. You're going to say, but hang on, if I go online, I can see these are selling for 200,000, right? So we will help you come up with what is the market value, what is the fair value for the company or the asset that you're looking at, and ultimately taking all of that complexity, distilling it, and quantifying it for our clients.
Okay. So I think I want to take us back a bit. Maybe we should have started with this. In Ghana, a lot of times we have businesses walking in, and if you ask any entrepreneur what their problem is, the number one thing is capital. It's we need money. And sometimes you realize after going into the business that it's not necessarily a capital issue that they need. They may need other things as well. So Jonathan, I would like to ask you, what are some of the key considerations a business should make before they decide to go in for capital or consider M&A?
Yeah, it's a good question. So, capital, it's the DNA, it's the balance sheet, and the strength of your balance sheet really determines how successful you can or can't be in your acquisition growth. We're talking about going to market and buying a business. Africa is challenging. The banks are fairly conservative of the level of gearing and debt they'll put into a business to allow it to potentially, say, buy another business. So what we find is if you have a strong balance sheet, that does give you flexibility. It allows you to have better options when you go out to market to potentially seek an acquisition. You're in a position of strength. You can put down a better offer. If you've got a weak balance sheet, it's the inverse. Then very much the offer you can make in the market for the asset you're looking at is very much determined by the level of gearing you can raise, which might be limited if you have already excessive gearing on your balance sheet. So it's a bit of a blend between flexibility and obviously the benefits of gearing. And I think people mustn't underestimate that gearing is a wonderful tool to use in finance to enhance your returns. But I do find in Africa, we find for growth businesses, it's equity they have to raise, unfortunately. There's very little appetite for debt. Sort of medium stage cycle businesses that can do a blend of debt and equity. And late stage, you can actually gear a business pretty well to raise acquisition finance. Africa, I do find DFIs are keen. World Bank, the likes of that come into it. Big balance sheets. Generally, the banks in Africa want strong net value underpin, so they like properties, etc., etc. So we find a balance sheet as a core tool to your M&A ambitions. If you've got a weak balance sheet, you're on the back foot to start. Strong balance sheet, you actually have more flexibility and options.
Okay, so assuming that we have a good balance sheet, Angela, I would like to ask you, what are some of the critical risk areas that I should look at as a business before I consider M&A?
As a business, if you're about to embark on multiple acquisitions, I think really understanding yourself, what we often say is actually as a parent, because if you're going to be acquiring companies, you're sort of bringing them in, how you operate, what's your culture, what are your systems, because the things that go wrong and mean that you don't realize the value in transactions is one, well, if you get the valuation wrong, that's clear cut, and you sort of overpay for the transaction. But then the other sort of losses in value from transactions comes from where you get the integration wrong. And that's where you don't bring the people in effectively. You don't look at the cultures. You don't understand how they come together. You don't sort of marry the business plans and ways of working. And you don't understand the sort of tech platforms. So you need to sort of, before you embark on multiple transactions, really have a clear view on what's your business plan, what's your plan for systems and tech, and how's that going to support your growth, and then how is each acquisition going to build into that?
Okay, so Wendy, we've looked at our balance sheet, we've looked at our business as a whole. and we've decided we want to go ahead with the M&A. How do transaction advisors or consultants ensure alignment between the business and the business's goals and the investor's requirements?
So I think with any of these type of deals, a lot of it goes back to is there a clear strategy that's been defined? Often we get called in because there's an aspiration in terms of what needs to take place, but a detailed strategy hasn't been defined. I think the second one where we see a lot of the challenges is around agreement at an exco level around what does growth mean, or where do we take the company to in the future. And so sometimes a lot of the work that we actually do is around speaking to each of the stakeholders, both internally and externally, and really getting understanding as to what is the expectation of that company and what do they want to achieve. And when you think about growth or an innovation agenda into the future, one of the biggest challenges is actually alignment from an exco position around what are the steps that we're actually going to take. So a lot of the time, it's not only on helping with the strategy part, it's also around the stakeholder alignment. And when you look at possible targets or you look at possible investments, it's about really understanding, as you mentioned earlier, what is the culture of that organization and what do they want to achieve. And I'm sure Angela will touch on it later, but the culture, the alignment of the executive, an understanding of what they want to achieve, the client base that you have, and also the impact that it has on your ultimate customer is really, really important. What we were chatting about yesterday when we were in Lagos is that often one can immediately go to an inorganic play, but sometimes it's also useful to think about other engagement models that says perhaps we partner together for a while. Perhaps we look at a particular initiative together as a while, in partnership. We test the relationship. We understand what we want to achieve together, and then we can take a position as to what is that relationship going forward.
Okay, so that's on the business front. What about on the investor front? How do transaction advisors ensure that investors are getting what they want out of any transaction?
I'll take that. Okay. Yeah, I mean, the investor base is key. So let's take an example. A private equity investor has a very specific returns model. So for the private equity investor, their most important thing, actually there's two most important things. The first is their exit. Can they sell this asset in 5 to 7 years' time? The second thing is the management team they're buying. So I think investors, if you take a term investor like a private equity fund, they need to understand that there is alignment between themselves and their fellow investors, in this case management, that they'll buy into the business, grow the business, and then position it for sale. So that alignment is key. If there's a mismatch in alignment, then you find there's value destruction along the way. On the other end of the scale, you have long-term, so infrastructure, which Yao works in. Infrastructure is patient, long capital. So there you need DFIs, pension funds, and the like to bring in their capital. So they're aligned with you. They understand it's going to take a number of years to realize value, realize cash flows, and exit. So I think there has to be strong alignment between all capital providers. Otherwise, you're going to get that stress in the system post-deal, which erodes value. So.
Okay, and so before we go to Jared and Sean, Angela, I'd like to ask you, before a business goes into an M&A, what are some of the strategies that they can employ internally, especially for businesses at the growth stage, to create value for the business ahead of transactions?
So I think we've talked to the key ones, but really it's people, technology, and sort of understanding your finances and how you kind of operate and your ways of working. So you really need to understand your operations before you go into a transaction to then be able to effectively bring in other businesses to your platforms and integrate them and realize the value in that process. And I think the real failing point in a lot of businesses is where they don't understand their own culture. And when we talk about culture, we're not just talking about different geographic cultures. We're talking about how you look at risk, how you do your finance, how you do your business planning. That all indicates what your culture is, and you need to understand that in order to then be able to acquire other businesses and integrate them onto your systems.
Okay, and Jared, so like y'all mentioned, we've had people walk in and say the value of my business is $4 million. and you ask, okay, what have you done to find it? It's just a concept. Literally nothing on the ground, nothing to show for it, but the idea is worth 4 billion. How do you as a valuation advisor value such businesses, and why do you think that valuations are important in the whole M&A transaction space?
Sure. So it's easy to think that a valuation is a number in a spreadsheet. And understanding value is a number in a spreadsheet, but it's not. As a business leader, as an executive, your role is to create value for your shareholders, for your stakeholders, for your employees, for everyone. So the first thing is understanding value. If you don't understand value, how do you make decisions? Okay. Now, when it comes to valuation and pricing, a common saying is that price is what you pay, value is what you get. Just because you're paying something doesn't mean that it's worth something, because what it's worth will be driven by fundamental factors like what cash flows does it generate, what market growth opportunities are there, etc. So it's very important someone can have a price and that's fine, but ultimately the price needs to be underpinned by fundamental drivers of value, which effectively, that's what underpins what the price of the asset is. So that's really where we come in and we try to bridge the gap between what is the price and what is something that's fair to pay, or what does someone want you to pay? Is it actually worth that?
Okay. So I guess for valuations, you're working on both the business side and the investor side as well. And Wendy, I will come back to you. So what are the key elements of a comprehensive business plan and a strategic plan for growth? What are the key elements?
Sure. Great question. I think if you look at the key elements, it always starts with the customer. So a deep understanding of your customer base and really understanding the type of customer that you're going after, be it a business or a retail type of customer. The second one is to clearly understand your differentiated value proposition and the competitors that you have in the market. And I find a lot of the time competitors come in many disguises. So within an industry, you might have your very traditional competitors, but with the advent of technology and the advent of a lot of horizontal players, there are many different competitors. So understanding your customer, understanding your competitors, your unique value proposition against them, and then being very clear on your operational capability and what do you need to actually operate your business. Your financials, of course, go without a doubt. And I think you've heard from both of us a lot about the people. Being really clear on who the people are in your business and what are the people's roles going forward. I think having a comprehensive business plan is a great way to create the right brand positioning within the market and to be able to sell your business effectively.
Okay. So Sean, I'll come to you now. We've talked a bit about the background, the business plan, the valuations and all of that, but essentially we will have to do a due diligence. We'll have to look into the business. So what do you as a transaction advisor, what are some of the matters that you find coming up a lot during due diligence processes for businesses?
Yeah, thanks very much. I think in any M&A transaction, it's probably one of the biggest decisions a lot of companies will make. So the due diligence process in itself is a very important process, and a lot of value can be gained or lost if poor due diligence is done. So really what we're seeing from a diligence perspective, it can cover a lot of different areas. So I think one of my colleagues mentioned financial and tax. That's almost a given on every diligence, but we do cover commercial and operational. There's legal diligence, there's HR diligence, there's risk and regulatory diligence, specifically around ESG compliance, is a theme that we're seeing. And on the IT side, it's very much around cyber as well. I think we forget that. So really diligence, there can be a lot of different risks in different companies depending on, the geographic location, what the industry is. And I think if you've got the right advisor, from experience, they know exactly where to look. What are those areas where there's going to be value leakage? And make sure that you focus on those areas, that you really understand the asset that you're buying, because the diligence really informs that valuation. So I think that's probably some of the most important things.
Okay, so could you give us a practical example of how, after evaluation has been done, the due diligence has affected the value of the business, whether upward or downward?
Yeah, great. If I just start with the financial diligence, part of it is making sure that the historical numbers are robust and can be relied upon to form the base of that valuation. But you're not buying the history. The history informs the future, but you are buying the future. So when you value a business, you may look at maintainable or sustainable earnings levels, but you also would do a discounted cash flow because you're buying the future. So a very important part of diligence is making sure you understand the history, but how that is likely to unfold into the future. And I think the biggest, let's say, value gaps are created where you suddenly just see hockey stick growth that is unsupported. And the diligence can sometimes help to bridge that gap, or at least inform the buyer on what is more sustainable or realistic. We would very much have a look at other risk areas. The ones that are key to evaluation is your working capital. Talking specifically around the SME environment, cash can be consumed and almost trapped within your working capital cycle. So that is probably one of the very big focus areas, and that leads into your integration planning and trying to make sure you can unlock value in poorly managed working capital cycles. And then, as Jonathan was mentioning around the debt, you do want to make sure that you understand that debt profile and how that unwinds and what cash flows are available and what security is available if you are going to be leveraging a transaction. Because if you get that wrong, you can get a liquidity squeeze quite quickly, and then you have to call our turnaround and restructuring team in, but they're not on the panel.
Okay, so Jonathan, Sean mentioned debt and the capital structure. So I'd like to ask, how does the capital structure of a business affect its ability to scale or its ability to access funding?
Yeah, so obviously, if you've got a strong balance sheet, it puts you in a really good position to engage funders and raise capital. And if you look at the capital waterfall, if you have a strong balance sheet, then you can approach a debt funder and raise debt. And debt is cheaper than equity. So strong balance sheet gives you that flexibility of now putting some responsible gearing on your balance sheet, using that gearing to, say, make an acquisition. And if you've done your math right, you've looked at your future cash flows, you can pay down that gearing and still then own 100% of the business you've acquired. If you've got a weak balance sheet, one, it impacts the ability of the price you can pay, because now you are limited to how much acquisition financing you can raise in the market. So the price you can offer is arguably going to be lower than someone with a strong balance sheet. So it's a very key fundamental in determining how strong you can be on the acquisition trail is determined by the strength of your balance sheet. So I think it's a super important factor.
Okay, so for a startup or an SME smaller, would you recommend debt? Would you recommend equity, and why?
Yeah, so a startup, generally rule of thumb, it's in its startup, it's going to go into quite a strong growth phase. It's generally funded via equity. There's very little appetite from traditional debt funders to loan money into a business that's unlikely to generate free cash flow for a number of years and pay down debt. And banks are very simplistic creatures. They want to give you a term loan, let's say it's 5 years. They want to see a clear, secure line of future payments to pay down the debt. They want strong asset underpin to secure it. Now, a growth business, a startup, has none of those. So it does tend to tap the equity markets, high net worth individuals, venture capital funds, who are willing to give it that capital, to let it burn the cash to make profit ultimately. Of course, the downside is you're giving away equity, so it's an expensive form of funding.
Okay, so Jared, I would like to ask you to tell us about a situation where a transaction was put at risk by pricing inaccuracies, where the business was overvalued or undervalued.
Sure. So there's a specific example I'll call on. We were pulled in to act as the buy-side advisor of a big listed company, and they were looking at an acquisition in the energy space. So this deal actually Sean worked on, and Zane, who's in the audience, our modeling leader, also worked on. So, the seller came to us and basically said, this business is worth around $200 million. Okay. they were also being advised by an advisor who was quite aggressive in terms of their pricing, and we were supporting our client who had a banker as well who was advising them on the transaction. Now the bankers came in the NBO phase, which is the non-binding offer, which is before the full transaction process kicks in. You get a set of forecasts. They did a desktop valuation. They got to a similar number, the $200 million mark. Zane and I come in, Sean does the due diligence, and we're looking at our outputs, and we're getting to somewhere around $30 to $50 million. Right. So we're saying, ooh, did we do something wrong here? I remember phoning Zane and saying, Zane, you sure we got this model right? Because, this is a massive gap, right? But we checked it, we had a look at it, we looked at the assumptions, and we said, no, this thing is actually worth a lot less than what the seller's trying to sell it for. Now, obviously, we then went down into the details, looked at the assumptions which was driving that, and we could tick off and say, well, this risk-free rate is too low, or this assumption is too bullish. Now, eventually what happened is we went, and I remember I am the one who had to present that first valuation outcome. I'm sitting with the owners, the managers, they're expecting us to come in and say, yeah, of course, we paid $200 million, no problem. I remember waiting for that slide, and the guys clicked next, and they saw the bridge going down, 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 and they looked at us and they were like, is this for the whole stake? Is this for, right? But again, that was a case where the best deal that could be done for our client was no deal, right? So that was a case where the deal actually didn't happen because it didn't make sense. They would have massively overpaid. So I think that's an example where we can come in. It's not just about going with the simple answer. It's about going into the details, about pulling all the information across DD, financial modeling, and coming up to an answer that makes sense for our client.
Okay, so Sean, I'd like to ask you, as a business, if we decide to go with an advisor, during the DD process, what are some of the key things what's some of the key values that you add as an advisor during the DD process? So for example, with Jared's example, if they had gone with a Deloitte and done an internal DD before going, what's some of the key things that you would have picked up that would have helped the deal to go through eventually?
Yeah, thanks. I think through my history of doing diligence for over 20 years, the list is very, very long. But I think if we just maybe focus on a couple of things, the value gap, most deals actually don't happen because of that value gap. And the diligence is really, on the one side, it's confirmatory. So it's making sure that whoever's buying the asset, in the analogy of buying a vehicle, you actually know what you're buying. You can actually confirm it. You've done the detailed analysis. What we do in our team as well, in the consumer business, we do a lot of analytics, Power BI dashboard. So we've got the power of the analytics capability to really actually understand that business, almost down to like level 3 data. And if you don't have that understanding, and you don't then understand the risk on how that transforms into the free cash flows in the forecast, you are going to be caught stuck. I did mention earlier as well that it's very, very important, whatever the risks are from the diligence perspective, it doesn't mean it's a risk that just is a price adjustment. That's a discussion you have with your client, that they really just understand, what they can confirm and what they may need to mitigate against. It may be a price adjustment. Our SPA team can also help with some mitigants on how you deal with some of those issues. Sometimes it impacts the structure on earnouts, etc. But you've got to look at the diligence process not just as just doing a diligence one time. It really is across the whole value chain. From a Deloitte perspective, we try and do it end to end. So Jared gave a very good example where we did collaborate both on the valuation aspects and after the diligence. And we actually said, well, there's such a big gap here. What is the diligence telling us? There were a whole lot of costs and layers of costs because the structure was very complex. Multiple jurisdictions, multiple subsidiaries and joint venture arrangements. Once you actually went through the spider web, what cash flow was actually generated, and it was very, very small. And our team and the valuation team and the client could actually go back and say, listen, we're not making this up. We've done our work, we've gone into the detail, there the facts are. And as Jared said, if the diligence wasn't done, maybe they would have just paid that money and then who knows what would have happened today.
Okay, so I would like to ask, we find that in Africa quite a bit, transactions go through the process and end up failing. So I'd like to ask each of you why you think transactions in Africa are not as successful, or why they end up failing typically. So maybe we'll start with you, Jonathan.
Yeah, sure. I think not just in Africa, I think deals fail on a couple of fundamentals, and it's not actually just price. They put price aside. I think in Africa, a lot of buyers underestimate a new market they're entering. They underestimate the regulatory side of it. They underestimate the foreign exchange side of it. They underestimate the tax complexity. And what happens, you find, because they go into the deal unprepared, because they haven't, let's do a punt here, they haven't hired good advisors to help them really get ready for a deal in a new territory in Africa, they find the deal gets bogged down in administration, in diligence, and it takes so long that there's deal fatigue, the guys walk away, the business stops performing. So I find Africa especially, you need to be fully prepared. You need to get people like Wendy in to help you on the strategy, people like Angie in to help you with how you're going to integrate this asset if you do acquire it. You need to get legislators in to help you with legislation and regulatory. Africa is a difficult market. There's not a whole easy raft of debt funding flying around. It's equity funding. Equity funds are very specific in what they want. So I think the only advice I can give to help and say why do deals fail is because I think both buyers and sellers don't do enough preparation. They go in and then they get caught out and then they get into the process and they lose value. So that's probably the number one reason is preparation.
Yeah, so I think building on what Johnny said, we always have a term that we like to use, start with the end in mind. And if you go into deals knowing where you want to end up and you have your strategy, they are going to be more successful. I think saying in particular deals in Africa fail, I would be interested to see the statistics, because I actually think globally deals often fail and don't realise their synergies. But I think the other element here that's a big one that causes a lot of value leakage on the deal process is the regulatory timelines. And often the ComCom here is a lot slower, is what I've found since I've moved to Africa. And so on that basis, actually really planning and using that time between signing and closing to make sure that when you get those keys, you can really start running with that business, rather than saying, okay, well, we've now got to wait for ComCom, and so we're going to just put our hands up for a bit and then get back to it later. I think that also passes on to with the start and end in mind, actually having the strategy done before you go into the deal.
So I wanted to pull on 2 points. I think one is that upfront work. So it really builds on what Jono was saying around the preparation and really understanding the market. I've personally been involved in quite a few deals in East Africa where I was the buyer. I don't think we spent enough time. We didn't know the market as well as we should have. We didn't meet enough of the targets. And I think there were unrealistic expectations on each side. And so I think getting to do the work up front, getting into the market and really spending time with each of them was really important, and muting the expectations slightly.
Yeah, I think a lot has been said, but in Africa, a lot of the deals actually change because of uncertainty, whether that's regulatory or political or from a tax regime perspective. Uncertainty often kills a deal, particularly if something changes from the time that you've done the diligence, now you're negotiating your agreements, and because sometimes it can take a long time, things can change in that intermediate period. So we've seen a lot of deals where there's been that, let's say, long lead time, and things start changing. I know in Africa, the different countries, the tax regimes are different. So clients are also looking, if there's been a change, does that impede the ability to actually expatriate that cash or to get that return, depending on what their structure is. So I would say that's probably the number one that I see.
No, I completely agree with everybody else. I would say that the key to getting deals done is to transact with confidence, not driven by sentiment. So as Africans, we're all familiar with volatility. It's a part of life, right? if you really understand your deal thesis, what are the parameters that are driving your transaction? If the exchange rate weakens, does it kill my deal? If risk-free rates go up, does it kill my deal? If a new competitor enters the market, does it kill my deal? If you're transacting based on sentiment, it's very neurotic, because if something happens, then you say, oh, I don't know if this is a good deal anymore. But you should know, right? You should have a good financial model. You should be able to flex those drivers and really understand, if these things happen, should I do the transaction or not? And that comes back down to having the right transaction advisors who can quantify that complexity and help you make the right decision. So what I've seen is definitely, if you're not factoring volatility into your transaction, if you're overreacting and behaving in a neurotic manner, your deals are not going to happen. And because in Africa there can be more volatility in other markets, that's often a contributor.
Okay, so I would like to ask the room if we have any questions, and online as well. If you have any questions, please put them in the chat and we will answer them.
Okay, so for the in-house, any questions?
All right, good morning, everyone. Obo, I'm with the Valuation and Modeling Unit. My question will be, unfortunately in Ghana, you don't have a lot of businesses listed on the Ghana Stock Exchange. And so I want to know, what are some of the strategies that you can deploy to sort of enhance their visibility and also the opportunities that exist on the market so that businesses can take advantage of to sort of raise investment capital?
Thank you.
If I understand the question, because you don't have a big listed set of companies, they're listed, they've got profile, they can raise capital from the market. Are you asking the ones that aren't listed, the majority, what they can do to raise capital, be more vigilant and have a higher profile? Was that the question? Yeah, it's a good question. The capital markets, the listed exchange is one place to tap, capital, and obviously if you're listed, it's a lot easier. You can do a rights issue, you can tap the market, raise your equity funding. If you're a private business, I guess the first thing you must do is get your house in order. So if you can, as a client, you can help them build their balance sheet to be creditworthy, strong governance, easily reportable, so it can be put in front of private capital providers, whether it be a bank, a private equity fund, a high net worth individual. That can definitely help them get the comfort that this private business is able to pay back the debt or the capital it's borrowed. So I do think it's a question of getting those disciplines into your clients, getting the belts and braces around the balance sheet and the income statement, so that when they approach funders, sure, they may not have a listed reputation, but they've got the governance behind it. They've got a Big Four auditing stamp behind it. They've maybe raised some debt in the past, successfully paid it back. They've got a strong balance sheet. They've got some asset underpin. But it's difficult, and there is a very limited debt market for private players, and the problem with equity is it's very expensive. I don't know if that gives you the full answer, but it helps a bit.
Yeah, I would say as well, it also comes back down to what are your sources of capital. So a listed exchange is one. You also have your private equity and your other funders, but the international markets are another. And a simple example, we had a workshop with a massive CPG company in South Africa. We were sitting with a managing director, and we were helping him prepare for a meeting in London where the big dogs, the big execs, were going to make a decision on whether to exit Africa or stay in Africa. And he had 30 minutes. Now imagine the magnitude of that decision. It comes back down to what is the story that you're telling? Are you telling the right story about your market? Are you giving them the right information to make those decisions? So we helped them in that case really put together something that was very concise, that helped tell his story as well as possible. And that's also a key part of it. So understanding the sources of capital and doing everything you can to maximize how much capital you can attract within that source.
Thank you. Kwame?
Hi, thank you. My name is Kwame. I'm with the corporate finance team. So I want to find out what are some of the key barriers that limits transaction advisors from fully influencing the investment climate, and also what can the transaction advisors do to align themselves either with policymakers or investors to address these gaps? Yes, thank you.
I think, it's a good question. the advisor role is an advisor role ultimately. And an advisor can give counsel, give influence, but ultimately the advisor is not the principal. And I guess it's the principal often will look to the advisor to have all these relationships. So I think for me, if you are looking for an advisory house, and Deloitte's a good example. Within this building, there's going to be someone in this building who can get access to someone in government, someone in industry, and so forth. The problem we find, especially on the African continent, is the fee question. People don't want to pay for an advisor, yet they want all the value from the advisor. And it's the truth, and we have it in our market, you have it in your market. So we have to be a bit creative around fee construct and fees, but what I've found is just as an advisor, a rough rule of thumb, you've got to give to get. So you've got to pick the client you want to invest in, and I'm afraid you're going to have to invest, and you're going to have to demonstrate your value, that you can unlock a corridor, you can introduce them to capital providers, introduce them to government. And that's the power of this organization and the common storefront we have. But yeah, to be taken seriously, you've got to add value and you've got to give to get, if that helps you. It's a tough question you've asked.
Jonathan, sorry,
Yeah.
I have a follow-up. So
That was all I had. Not much more, so don't scratch too deep.
well, I mean, anybody can take it, but so let's put ourselves in the shoes of businesses.
Yeah.
We're looking for money.
Yeah.
We're looking to expand. Why should I use the money to pay an advisor as opposed to putting it into my business? And anybody can take this. What value will an advisor add to my business that I would otherwise not have?
I'll kick off, but I've raised capital for numerous clients. I understand how banks look at the investment credit committee document. I understand the levers they need to be pulled. I understand what the banker in that example needs to see. So as the advisor, I can help the client position if they want debt, how to get the best debt out of the banker, and how to bring a competitive tension to that process. So I think an advisor plays an invaluable role in understanding the counterpart. It's very key that we understand what the counterpart is looking for. You trying to do this maybe for the first time. You've never done it before. We've done it before. We understand where a red flag is ticked and where a green flag is ticked. But most importantly, we understand how to address the red flag. And a client doing it himself, he hits the red flag and he's failed at the first hurdle. So, yeah.
I think I just want to add just on time. Most founders or people running a business are trying to run their business. And if I can just add to all the expertise that Jono listed, a lot of the time what we find is that there's not enough time in the business to do the exploring part, to explore all the different avenues in terms of what they want to achieve. So by bringing on advisors, not only are we able to leverage the skills in the business, but we're able to accelerate the process really quickly.
Yeah, I would say 100%. If you just think about the different components of that, the first part is the decision to grow, right? Winnie and the team do this every day. We've seen many different industries, many different customers, and this is what we live and breathe. As a business owner, you're focusing on your day-to-day operations. You're trying to get things done. You haven't necessarily seen that breadth of operations. Then when it comes to raising capital, our teams do this all the time. Like Jonathan said, we know how to raise capital, we know who to approach, we know how to package it, we know how to do all of those things. And then when it comes to deploying the capital as well, it comes back down to what is the most effective way to do that. And we can leverage learnings not only from the local market, but from the broader Africa, but from across the globe. Right? And that's a benefit that you get from an advisor, is that we've seen a lot of different things and we can give you good advice. So it's a tough decision to say, I've got X amount of money, I could pay an advisor to help me, or I can put it into the business. It really comes back down to you. And in some cases, maybe the decision is not to use an advisor, but a lot of the time you'll get a multiple on that investment, because the way you deploy and what you grow to will be backed by the power of 1,000 similar experiences and expert advice.
Okay.
I think I'll just add one final point on that is actually also working with advisors, what you learn from the advisors. So if you're going into your first set of transactions, the way we operate, and I think sort of most advisors, well, and especially in Deloitte, is we very much partner with our clients. So actually there's a lot of skill set and capability that sort of through a transaction process, a business will learn. So it's not just that you've given money to the advisor, you've actually built up capability through that process and learned from your advisors in the process.
Okay, so we have a couple of questions online before I go back to the room. Philip Mensah would like to know, all the transaction advisors are focused on figures, but what about the human capital DD? So, Angela?
So HRDD is critical, and you should be looking at it. You need to understand, and I've already talked to it, you need to understand the culture, you need to understand the leadership, you need to understand what the succession plan is. Is there a succession plan? Because that's a real red flag. If you might have 3 great leaders there, but what if they leave next year? And then you also need to understand the reward structures, and do they actually work, and are they sustainable with the business plan? Jared mentioned sort of your model. A key component of your deal thesis model is the sort of people, and what's the people plan, and how does that pan out? And if you were to remove people from that plan, or remove leaders, what's the impact on that business? And so doing the HRDD up front, and then sort of creating a plan around it. And when we do integration work, one of the first things we look at is the people aspects, to see sort of, well, what do you need to do at day one when you take over that business to make sure that from a people perspective, things continue to run seamlessly?
So I think that's also the power of the full end-to-end M&A, right? Because as Angela mentioned, succession planning, let's say you buy a business and the executive is super important and they're the ones who drive the value. Jonathan and the team will then come in and say, well, let's structure the purchase consideration in a way that incentivizes the sellers to stay or locks them into the transaction. So that's a benefit of, you pick something up in the human capital DD, you build that into the valuation model, then you structure the transaction in a way that optimizes your value. So I just want to point out that's a good example of where there's a softer qualitative thing. At the end of the day, you do need to try and reduce it into numbers and still bake it into the way that you do the transaction.
Okay, thank you. Samuel would like to know, how does the investment community see a company that tries to build its own transaction or deals team internally and not use a transaction advisor? Do such companies come off as weak and unserious in the big picture? And what sets apart transaction advisors from such internal teams? So I guess the question is more along the lines of doing it internally as opposed to a transaction advisor, and how the investment community sees that.
I'm happy to start on the doing it internally. I think there's one thing that we clear. A lot of big companies and small companies have their own internal teams, and if you're about to go off and do an M&A agenda, you probably should have your M&A lead internally, because advisors are advisors. And so actually it is beneficial to show that you're thinking about M&A seriously and you've got the right capability in your business to run deals. But even if you have your own M&A team, you still need the transaction advisors who have done multiple deals in different industries to actually look at sort of what's happening and help. And we're actually seeing it more. Like, we've currently got a deal where basically the client that we've supported on the DD, they now need to show that they have an integration advisor, because the seller is nervous that they don't have the integration experience. And so as part of their binding offer, they've had to say, we've actually accepted a proposal and we've got Deloitte who are going to help us with this integration.
Yeah, another one is conflict of interest. We were on a transaction where in-house legal were negotiating the incoming CEO from the target's package, his remuneration package, his incentive package. And he was very soft in the negotiations because he knew that same CEO was going to dictate his remuneration package post-deal. Now, you laugh, but it actually was one of the main flags we picked up, that he was being very soft on the negotiations because he knew down the track he'd be at the other end of that table. So you can get a bit of a conflict of interest. We find the big organizations, you won't have that. You know, the corporate finance team internally report into a well-governed structure, so maybe that was an anomaly. But I do find bringing external advisors gives the internal team a much better feel for what is happening in the market versus what is specific to their company. So that blend's important. Yeah.
Okay, Angela, there's a follow-up for you. It says, why do some M&A transactions fail to achieve synergies and other benefits after the transaction?
I think we've talked through the key ones, but really sort of in terms of failing to achieve synergies, sort of not understanding why you're doing the deal, not having a clear view on actually, okay, we've set the synergy case, we've built it into our model, as Jared talks about, but then what are the parameters that are going to influence it? What's happening with tech? What's happening with people? What's happening with your customers? How are you growing in that market? And so I do think there's a big element. I'll hand over to Wendy. Really, if you're going to go and do a load of deals, you need to have a strategy. And what does that mean for your overall business? So you kind of need to have your inorganic growth strategy to then be able to successfully have a sort of, which creates the framework for the synergy case that will be created in each deal and enables you then to effectively realize your deals, your synergies.
I think I want to add to that. I think I'm going to speak again because all the elements have been covered, but I think a lot of the time we're also finding if there's a change in leadership or there's a change in terms of what's happening, some of those deals can definitely take a left or right angle in terms of what they're doing. So often we can start talking to a client about a particular growth strategy, and maybe that involves a transaction, but if there's a change in that or there's a change in any of the structures, that puts a lot of those big deals under threat.
I think maybe the last one there is the importance of the 100-day plan. So the hard work actually starts once the deal is done. And I think what we found, particularly in growing companies, someone may do the deal, but someone different lives with the deal. And I think that is very important, is really understanding that integration planning and who's going to now take the deal forward and be responsible for making sure those synergy cases are realized and actually understand the synergy case.
No, and I think to add to that, best practice very much is you should appoint your integration director early on. So in the diligence phase, you should already know who's going to actually lead the integration and deliver on the synergy case. Because otherwise, you see it less, but it still happens, where you actually almost get to closing and then it's like, oh, this guy's going to be now running the integration and he's got none of the background of the transaction to date.
Okay. Another question. Will an investor still be attracted to a company with a weak balance sheet with the intention of supporting the company strengthen its balance sheet?
Yeah, you must remember, a balance sheet is a point in time. So if it's a weak balance sheet at a point in time, it doesn't mean going forward this business can't perform and strengthen its balance sheet. So you must remember, and Jared probably is better based to look at this, but the fundamentals looking forward of the business, if the business has an ability to generate strong free cash flows, yes, maybe today the balance sheet is weak, but over time, if it's generating strong free cash flows, it's going to be able to de-gear that business. But it comes back to, don't start at that aspect first. Go back right to the fundamentals. Is this business weak because it has a weak balance sheet, or is this business weak because it has a weak income statement? Now, there are two differences. Buying a strong balance sheet with a weak income statement also isn't good, because over time you're going to find you're in that position. So not necessarily a weak balance sheet is a death knell for a deal, no. It comes down to the fundamentals of whether going forward this business can right-size its balance sheet through performance. I don't know if you want to add to that, Jared.
Yeah, no, I would say there's three drivers in terms of the value of anything. And it's the cash flows you can generate, it's the risk of those cash flows, and it's the ability to grow those cash flows. That any valuation situation comes down to those three things. Now, a weak balance sheet impacts that in a certain way. So if you've got a weak balance sheet, you may be paying a lot of your cash flows away in debt. There may be additional risk because you've got so much of leverage, it could create financial risk. And it may impact your ability to grow because of the fact that you're paying so much in debt and you're not able to raise as much funding. So it's an influencing factor, but it doesn't mean that if that's the case, but you've got a strong fundamental business, you're generating strong operating cash flow, it doesn't mean that that's the end of the story for you.
Okay. Kwesi would like to know, can the panel give a brief overview of what a completion mechanism is in M&A? And the second part of that question is there always a need to employ the use of a completion mechanism, or can it be done without?
Sean, you want to take that one? Completion accounts, I do believe that's part of the SPA service offering.
No, sure. I think what's important in a transaction is to understand when ownership will transfer. So at what point do you actually own those cash flows, and that you're responsible, for the debts of that business as well, and when the cash flows will accrue to you. So there are a number of different mechanisms you can use. You may have heard of the lockbox mechanism or completion accounts, and both of those have different rights and responsibilities of when you own those cash flows And more importantly, which links to your sale and purchase agreement, is what leakage is permitted between, let's say, the deal value and when the ownership actually transfers. Because very often, in Africa, that can take a long time. And what you don't want is to do the deal you sign, but there's significant leakage that wasn't considered in your SPA and how that will be treated. So, the lockbox mechanism, completion accounts, what we've also seen is actually a combination of both, where maybe the advisors don't really understand what each one means. So I think the takeaway is really to have an advisor that understands that and make sure that that is linked into your SPA and that is reviewed and signed off by the advisor. Because when you talk about cost versus value, if you get that wrong, that is money out the door, that is value leakage that you can actually count the cost of. So if you're going to spend any money, spend it on that.
Okay. Michael would like to know, how does AI impact the future of the entire advisory industry, and how are advisory companies adjusting to this change? So I guess, yeah.
Sure, no, I'm happy to take this one. So it's an interesting one. You get people on the one hand who think AI is going to do everything and we're just going to sit, put our feet up and chill for the rest of time. You get some people who think that AI can't do anything and it just hallucinates and it doesn't know what it's doing and it's a waste of time. The answer is always somewhere in the middle, right, with most things. So it won't just, but AI will impact broad swaths of the economy, not just transaction advisory. But in terms of transaction advisory, what it is doing is it's helping with some of the more manual routine tasks, right? So AI can do simple tasks, it can do it effectively, never sleeps, never eats, never chills, working all the time. So that's definitely some of the areas where we're looking to integrate AI, is to use it in places where the task is quite well defined, the task is not too complex, and it's repeatable, right? What that means is we're saving the time of our practitioners to spend their time on the more complex, judgment-driven areas. And that's where we really add our value, right? When we, as humans, when we use our mind, when we connect the dots, when we take big pieces, a lot of information, synthesize it, and produce insight from it. So certainly over time, a lot more work is going to be done by AI when it's a simpler, more routine task. My personal view is it'll still be a couple of years before AI can really take those difficult judgment calls and make those real insightful decisions.
Okay, Yao, I would like to borrow you. There's a question specifically to Ghana. So, Emmanuel from Challenge Ghana would like to know, what are the main factors that affect and either encourage or discourage investors from engaging with Ghanaian businesses, especially SMEs?
Well, I have a very simple answer. I'm not on the panel, so I'm not. So I guess for most of the transactions that have been successful, let me start from that. There have been instances where we've started with businesses that have got weak balance sheet, as you discussed before, and we've helped them to do what we call balance sheet enhancement. So most of the business that we've seen go through the proper and successful transaction process go through what we call investor readiness. There's a high-profile beverage company that we work through that process. So when we started a good business, but we realized that they didn't have some compliance measures, especially ESG. They were not ISO certified. So after they went through that, their value shot up significantly. And that actually enhanced the transaction process. So a lot of businesses want the capital today. They rush through the process, and I don't think they get value. I'll give you another good example. So we're also working on a transaction on a tilapia business. And when we started the transaction process, the business was worth 10 million USD. So after we started the transaction, about 2 months down the road, there was some attack on the fish in the dam. And so it was some disease that affected most of the tilapia operators in that area. And so the business that was worth 10 million USD was then valued at 2 million USD. The guy nearly gave up on even the whole business. He says, look, the guys can come and take it for free. He's just giving up. So not identifying the risk and not going through the proper process. So for the buyers, they were happy that they did not rush through the process. If they had rushed through the process, they would have been paying for the cost for it. So it's important you take your time, understand the market. And one key thing that I see in Ghana here is the regulatory changes. We've mentioned that. So every year in November, the budget is read by the Minister of Finance. They will either increase a tax, introduce a new tax, and all of these regulatory changes have impact on transactions, particularly depending on the sector that you're operating in. So you'd have to understand the regulatory environment. We have very interesting scenario where clients walk up to us, they want to do a deal, and all that they are saying is just do financial due diligence. I'm not interested in tax, I'm not interested in legal issues, but what actually makes the transaction fail is not the financial. It's the legal and regulatory issues. So you have to understand the legal and regulatory issues, especially in Ghana. If you fail to appreciate that, your deal will fall through.
Thank you. Okay, Asante would like to know, how can we position ourselves to woo investors? How can we in the agribusiness space position ourselves to woo investors? Sean, would you like to take that, given your agribusiness background?
Yeah, so you probably need to start and see where you are on the value chain of agribusiness, because it is, the risks are quite different depending where you are on the chain there. So you will see from a private equity perspective, a lot of the funds are actually, unless it's a agribusiness focus fund, they don't invest in agribusiness, just because the risk factors there are the climate, sometimes people, labor issues, regulatory issues, and they just see the risk as being way too high. And if you value those businesses, the risk return doesn't make sense. So I think what is important is really around the value chain. And where we're seeing a lot of value created in agribusinesses is where the business is vertically integrated. Because what you then do is you diversify some of that primary agricultural risk away in your valuation, and really your value proposition then changes. Depending again on what the industry is, the big issue is how do you add value as opposed to just, growing something and selling it. How can you take that primary product and actually add value? And I think a very good example is the dairy industry. If you just produce milk, you don't make very much money. The money is actually down the value chain. Once you add value, you make yogurts, and now you've got vegan and you've got low fat and all of these things. Have a look in the shops what you pay, and if you can own that side of the value chain, that is really where you enhance. I think primary agriculture, to raise funding there can be very difficult.
Okay. Francis would like to know, as transaction advisors, do you also seek external advisors for your internal transactions?
I can take this one. I've looked at a couple of internal transactions for the firm. We do back ourselves to know what we're doing when it comes to transactions. So typically we do it internally.
All right. Elizabeth would like to know, in your experience working in Africa and Ghana, what would you consider the key capacity or institutional gaps that limit the effectiveness of transaction advisors in improving the investment climate? And how can this be addressed to boost confidence in transaction advisors as well as attract more private investment? Anybody?
So I can start, and I mentioned it before. I think a lot of the time it is volatility, and one thing that especially international investors want, but depending on the fund, so Jonathan mentioned before, if you're private equity, you have an IRR hurdle and you want to make X amount in USD. One of the challenges in Africa is if there's regulatory uncertainty or regime changes or a lot of volatility, it makes it a less attractive environment, especially if your return profile can swing a lot up and down. So I think a key part of that, I don't know how to solve that issue, but that's definitely one of the issues that we see. I think just from an investor side, what does help, and even from a seller side, is really to make it clear to an investor, these are the bounds within which you can still make your return. right? This is my equity story. This is how things can flex. This is what it's done in the past. Even if it does this, I'm still a good investment. And that's one way to package it. Not to pretend like everything, there's not going to be volatility. There will be, right? But price it into the transaction, show that you've thought about it, and include that in your deal parameters.
Okay. IFWA would like to know, what is the significance of a transaction advisor in enhancing financial efficiency, compliance, and strategic growth of a credit union?
Yeah. So I think, I think when you come to transaction advisory, so there's broad advisory, there's transaction advisory. So obviously, as part of transaction advisory, a lot of what we do is linked to a M&A transaction or a fundraise. What we would do is we would bring in the right experts in our financial risk teams, in our risk regulatory and forensics teams, in our assurance teams, to make sure that we have the right expertise advising our clients in packaging information so that it makes it ready for a deal. If it's a broader question on credit unions and how they should be reporting, etc., we would pull in the right experts who have done this before and who have that very niche sector expertise to support.
So Elizabeth again would like to ask, how are the common mistakes of startups, example fintech, how are the common mistakes on the side of startups, example fintechs, aside unrealistic valuations that make it difficult for them to raise capital? Okay, so what are the common mistakes that businesses make, startups, that make it difficult for them to raise capital?
So I would say from a startup perspective, startups a lot of the time are driven by momentum, right? The reason you're getting valued at a certain amount is because you are promising your investor that you can continue to grow and continue to generate value. The risk you have as a startup is, again, the $4 billion example. A lot of the time a startup founder would want to value their company high because the higher they value it, the less dilution they have when a startup investor comes in. The problem you have is if you value it too high up front and you don't deliver on the promises that you're making, that is a massive red flag to an investor, right? So they call it a down round, but let's say you value a business at $500 million, you raise capital at that, but you promise this J-curve. It's a massive hockey stick. The next time you're looking for capital, you haven't delivered on that. That investors could want to pull out. And remember, you are entirely dependent on your investors to continue operating. So it's a very tricky balancing act, but one of the things we often see is startup founders being too aggressive, wanting massive valuations. At the end of the day, you have to deliver on that. And if you don't, it can be catastrophic.
From a strategy perspective, I'd say for many fintechs, it's evaluating if the problem that they're solving is big enough. And so a lot of the time it gets back to scale. So regardless of what the evaluation was at the beginning or what they're saying in the market, it's being super clear that the business problem that you're solving is big enough to get you to scale.
Okay, are there any more questions in the room?
Yes, Samira. I think I'll go to Elom.
Hi, my name is Elom. I work with the corporate finance team. So my question is, beyond investments, how can transaction advisors help businesses build longer-term relationship with investors?
Thank you.
As transaction advisors, how can we help build for our clients or for ourselves the longer term relationships?
I think we've got a very strong network, so.
Yeah, I mean, I think Angela's right. We try to take our clients to the investor pool. So by doing that, I guess we leverage our relationship to put our client in front of the right stakeholders. But in order to help them, I guess we try and position them, help them with the narrative, the growth story, the return model, all those good things. But we take them on a roadshow is really what we'll do. We'll take them to meet various different kinds of stakeholders, various different kinds of investors. And just by doing that, it increases their profile. Yeah.
So remember also, as transaction advisors, we're the glue between buyers and sellers, right? So there doesn't have to be a live transaction for us to be able to assist in connecting the dots between buyers and sellers. So that's, the transaction advisory part, which is quite M&A focused, but certainly from a broader Deloitte and firm perspective, we are the glue. That we have networks, we have links into many different buyers, sellers, industries, etc. And we often help our clients connect the dots that way.
And maybe one last thing there, it is important when you look at Deloitte as a financial advisory business, we actually give independent advice. So it's not like a bank says, listen, I'll advise you, and you have to use me because I'm providing the balance sheet or the funding. I think that's a very important bit. And obviously, internally, we would have our own processes to make sure that when we're advising a client, they are credible. And the story that they are selling is a credible story. So you add that independence and you add that credibility.
Thank you, Simran. I think we have one more question, George.
Okay, thank you. This is more PPP related. I think, Jonathan, you mentioned at a point. So in the instance where transaction advisor is in the room, and there are different interests in the room, particularly when it's complex infrastructure projects. You typically have the project owner in there, you have the financier in the room, you have the government, other regulatory agencies, all interested in the transaction. Are there any pointers in managing this? Because as the advisor, yes, there's an interest to also see this successfully closed, but how do you manage the different interest in the room, given that it's all towards the project to make sure this happens? Are there any pointers, maybe from your experiences on the transactions you've worked on in that regard?
I mean, I'm not an infrastructure specialist, but like any transaction, you've got to understand each stakeholder's objective. What's each stakeholder trying to achieve? And you've got to be able to manage those objectives across multiple parties, find the pieces of commonality and find the pieces where they differ. And your role as the advisor actually is to try and connect those dots. So, infrastructure is a long game, lots of stakeholders, as you say, government, funders, the general populace. And you've got to understand what each stakeholder's objective is, and very important, you've got to understand which of the stakeholders have the most sway in the room.
I would say as well, it's easy to refer to parties in the room as stakeholders, but all of them are also human beings, right? So it's very important to understand, what do we want to achieve? What is in the best interest of those individuals as people, not just as the institutions that they represent, etc. What do they want to get out of it? And as Jonathan mentioned, it's about what is the golden thread that I can pull across all of those interests that'll get something done. So it's also just to remember, we're dealing with humans, they have their own incentives, they have their own fears, their own risks. How do we unpack that? How do we really understand and get a sense of the room?
If I bring it back to design thinking, which we use often in strategy work, we talk about the gives and the gets. And so when you're thinking about a complex relationship like that, one of the things to do is to think about, for every single person, company, stakeholder, institution, what do they need to give to what's happening and what are they going to be getting out of it? And often when we create strategies for platform businesses or where there are multiple stakeholders in that business, it's about truly understanding the gives and the gets to what they're going to be seeing within that transaction.
Okay, Jared, there's a follow-up question for you. So it says, what are the common biases that investors consider when looking at how quickly they'll earn a return?
Common biases. Okay, so I think what I would say is, we mentioned it before, an IRR profile, right? So a lot of investors want to generate a return, but an internal rate of return is a single number. It doesn't reflect the pattern of the cash flow. So you can get an internal rate of return that is negative 50 for the first 5 years and positive 100 for the next few years, right? So I think people underestimate that and they try to summarize the entire return profile into a single number, whereas it's important to look at a couple of different things, right? What is your return requirement? What is the quantum of it? Over what period? And what risk are you willing to accept to generate that return? So I think one of the common biases is really just looking at a single number, assuming that's the be-all and end-all, instead of truly unpacking that, having that model that'll give you those metrics and understanding how that matches up with what your requirement is.
No, that's it. Do we have any more questions online? Okay. you read them out? I don't have them. Okay, I have one coming through now. Eva would like to know, if investing into primary production is difficult for investors, would they consider investing in machinery for the sector? For example, an agribusiness entrepreneur who supports by providing land preparation and other mechanization services to smallholders. How likely would investors be to fund machinery? Okay, so I guess it's for startups. And the question is around if investors will be willing to finance machinery as opposed to primary.
Maybe I can start on that. So asset-based financing, is a well-known route to finance. So certainly if you can find a piece of machinery and demonstrate the utilization and the return on that asset-based financing, you've got a bit of security, and that certainly is a way to do it.
No, agreed, Sean. I mean, if you can demonstrate you've got a pool of small micro farmers that you're going to effectively be their contract farmer, you're going to put the yellow equipment in there and they can pay the return. It's bankable. I think the risk is it's agricultural. May take a long time for the product to grow, to harvest and convert to cash, then to pay the guy with the yellow equipment so he can pay back his funder. So I guess the challenge is the timing of the cash flows, but spot on, yeah.
So we were involved in the launch of an agri platform that did exactly that, and I completely agree with Jono that the key thing here is if you're working within that environment, you need to be thinking about who you're partnering with, and the key partners there would be the off-taker, as well as banks who could provide working capital to the smallholder farmers who can then pay you for the inputs. And so if you're running a tractor business like Hello Tractor, which is a very successful business in Nigeria, where they offer mechanization to communities of farmers, the way to do that is to make sure that you have understood the entire ecosystem and understood how money flows. And if you understand how the money flows and you're able to evaluate it as an investor to see that there's security in the way that that company would get paid.
Okay, Eva again would like to know, how can transaction service advisors make their services more affordable to small-scale businesses? Yeah.
I always say I'm not on the platform, I'm not on the panel, so so I'll start with our collaboration with an entity called GVCA, so Ghana Venture Capital or Private Equity Association. So under that arrangement, we have SMEs that are sent to us for business advisory services at heavily discounted rates. But you have to be a member of the GVCA or you have to be on that platform to benefit from. So there are such or similar arrangements like what we have with UKGCC. So if you want to benefit from advisory services at discounted rates, just participate in some of these investment programs and you will benefit. So register to be part of the platform and we'll give you discounted rates. In my opening remarks, I said that we are not expensive. We give you value for your money. I've had instances where businesses or SMEs have complained that we are expensive. And then I asked, how much did you pay for the boutique firm that you engaged that did not see you through the previous transaction? And they have paid 3 times what we would have charged. So they are comfortable paying 3 times what they pay us to a boutique firm who will fail as opposed to engaging firms like us. So sometimes what you think is expensive might not be the case. You walk to us and we may charge you something that will even amaze you that, oh, is it the case Deloitte has been charging this fee? Yes, we've been charging fees that you are able to pay. So our services are affordable and they will give you value for your money, like I said. Thanks.
Thank you, Al. So the final question, and Heda, do you have any more? Sorry. Yes, okay. So the final question, and I think I will target that at Mr. Usu, or he will he will address it in his closing remarks. So it says, I think most SMEs don't see the need for an advisor, especially in Ghana, when they want to raise capital or venture into new businesses. What can be done to make SMEs see the need for advisory? So I'll ask the panel to answer this as your closing, give your closing remarks in answering this, and then Mr. Owusu as well will answer. So Jonathan, sorry, Angela, please go ahead.
Happy to start, and I'm also going to do a slight plug for our private equity confidence survey that it's being released in 2 weeks' time. But so Africa actually is one of the few regions in the world where we're seeing a growth in the funding environment. So in theory, there is more white powder around, but it's how to harness that. And I think where I would say transaction advisors come in, and we've touched on it a few times in different angles, is the network. Like, this group has just spent 2 days in Lagos talking to over 20 private equities and clients and DFIs and World Banks. So we know all the people. So by engaging advisors, you're bringing in the best opportunity in order to get the best sort of investors into your business.
And I'll also echo what Yao was saying. We bring value. And what I mean by that, I'll give you a practical example. So SME client of ours wanted to raise funding, said they would go to their incumbent bankers, didn't need our advice. We convinced them, let us on risk see if we can do a better deal for you. So we approached the market. I think we must have sourced about 8 or 9 term sheets, and surprise, surprise, his incumbent funder came in stone last. And we sourced the funding at a far better rate, and we actually shared in that upside. So that's how we got around the fee dilemma with them. So, yeah.
I think from a strategy perspective, we've got very simple and effective ways of helping you to create, validate, and review your strategy. And so the maturity that then shows up when you speak to investors or other partnerships is much more evolved than perhaps when someone started. So always happy to do that work.
Yeah, I think the final comment from you is just, use people that have done it before, that have seen it, because if you try and do it on yourself, the chance of success is probably more limited. And again, it just goes back to the value thing, and Yao mentioned discounted fees. Jonathan mentioned contingent type fees or fee sharing models. So, you can get the right advice if you just look at it. And, from a Deloitte perspective, subject to independence rules, we always do try and be innovative as well on the funding structures.
Yeah, I would say it's tough to be an SME. So, focus on what you're good at, focus on where you need to pay attention, and let us focus on the transaction side. It's what we're good at, it's what we do, it's what we focus, what we've dedicated our careers to. So I would encourage smaller businesses to focus on that and come to us to help them focus on the rest.
All right. Thank you very much, panel. Mr. Owusu. Why should they come to Deloitte?
All right. Thank you. So maybe just take this and I will do my closing remarks. So why should they come to Deloitte? And I will answer that by saying that my response is a summary of what everyone has said. And to say sometimes you can sit in your corner and you think you don't have help, but you can also decide that, okay, you want to speak to people and you see that there's a lot of help that are available that are not untapped. And that's the reason why you have to speak to people like us. And again, you see if you are speaking to Deloitte in Accra, you are speaking to almost 600,000 people, because we can connect you here in Africa, and even we can connect you to people outside who know where to find the help that we are looking for. So it's expensive. You say it's expensive, but I can tell you that people who have got closer to us have seen that there's value that we deliver, and it is value that you are paying for, and you can pay for it. Just come around and speak to us, and you will see that definitely that's the way to go, because we will create opportunity for you and we'll grow with you. and you find that there's a space that for your kind of business you can still fit in. So just come and talk to us, and we'll find a way for you. Okay, just let me conclude by saying thank you to the team, and I think this is very powerful. They've moved from Lagos to Accra here today to talk to us, and that from the beginning, the significant issue that we have for businesses, for startup, is funding, and there are people that have enormous funds. They are also looking for others to partner with. So the solution that you are looking for, that is also someone's problem. And so I will advise everyone to come just talk to us, and our team will be happy to assist. So let me say thank you to the team that have come, African Strategy Leader, all the way from SA, African Corporate Finance Leader. We have PMI and Value Creation Service Leader. We have African Transactions Leader. We have African Valuation and Modeling Leader. They've all come all the way from South Africa, so a round of applause for them for coming all the way to talk to us. And let me also say UKGCC, I think this is the third or fourth one that we're doing. This is the third, okay. So thank you for the collaboration, and we look forward to having more of such collaboration with you. And for me, this is very timely. Timely because this is the time that we see a lot of people trying to identify opportunities in businesses that they can tap. And this is a time that we are trying to open up the chance and opportunity for many of these startups that are coming with the government agenda and the focus on the youth and the small businesses. And so there can be a better opportunity like this to talk about this topic, where we have people that know how to find people that are looking for what you're also looking for. So once again, thank you, and thank you to the team that have put this together, our own Ghana team, and your team. Thank you for putting this together. A round of applause for them as well. Let me thank all the organizers for putting this together, and we look forward to seeing you once again in another collaboration with UK GCC. And thank you once again for participation and for leading the discussion. Thank you.
So thank you, Dan. So in a couple of minutes, you will have lunch. It's a buffet. So you pick and choose. So you start from Ghana Jollof, and then you eat the others. So thank you very much. But please, the business leaders are here. If you like to ask any question, there will be one-on-one session. Please feel free to ask them questions whilst we prepare for lunch. Thank you.
This is Deloitte Ghana. By building on Deloitte core purpose of making an impact that matters, we are a leader in professional services in Ghana. Across many Ghanaian professional services firms, our identity can be traced as far back as 1947. For the first time, here is our story. Meet some of the people who started it all. In 1939, James Donald Barnes, a Scottish chartered accountant, arrived in Gold Coast as an internal auditor of a United Africa company. This was an era where there were very few qualified accountants in the country, with most of the pioneering accountants in West Africa being foreigners. Our story in Ghana began on 1st January 1947. J.D. Barnes opened his office under the name J.D. Barnes & Co. Chartered Accountant. In 1954, Mr. Barnes spearheaded the formation of the first registered professional accountant body in British West Africa, the Association of Accountants in the Gold Coast, which will evolve into the Institute of Chartered Accountant, Ghana, in 1963. Focused on making more impact, Mr. Barnes made strategic mergers between 1955 and 1972